informed is the Fed in making this last decision of 2025, considering the lack of data still kind of trickling its way through because of the government shutdown?
Look, I think that the Fed is actually very well informed. We have so much alternative data that if you were really depending on a single jobs report number, you just fundamentally don't understand the economy. I think that I give the Fed enough credit to, and the Fed staff enough credit to think that they have some reasonably strong understanding of underlying economic activity. I think that what's going to be most difficult right now, though, is communicating about the economy when they don't have a lot of the key indicators that we use as common reference points, things like the unemployment rate through October and things like CPI through October. If you're going to say that you're data dependent, but you don't have those specific reference points, it becomes a little bit more difficult. But when we look at the broad swath of economic data, we're looking at dozens of alternative labor market indicators. We're looking at dozens of inflation indicators, and so is the Fed.
Okay, Stuart mentioned some of the indicators that we're looking at if we don't have all of the official indicators that we would typically see and that the Fed would typically see, Michael Mackenzie, ahead of a policy meeting. When you look at all of the data for jobs, for inflation, what do you see?
It's definitely softening, and I think what's problematic about the meeting tomorrow is that the data that the Fed needs doesn't get released until next week. You're going to get November jobs, November CPI. And so the bond market right now has sort of pushed yields up to kind of the highest levels we've seen since late September for both the 10-year and even the 2-year. And they've actually made January, they've sort of taken out the expectations of another cut in January, and they're pretty low expectations for a cut even in March next year. So the idea in the bond market is that the risk is that the Fed could be pretty hawkish. Powell could keep things open-ended, which he's likely to do. And we'll get a cut tomorrow, but the trade is January still going to be a pause, and we'll get an idea of whether January is a pause or is actually in play when we get the data next week.
What's trickiest for the Fed right now? I look at that dual mandate, right, in terms of full employment, price stability. Which one, Stuart, right now is more difficult or presenting more of a challenge for the U.S. Central Bank?
Well, getting inflation back down to the 2% target is the most difficult.
We've been trying for how long now? Like, it's a while.
Yeah, I mean, look, COVID preceded the major inflation push, and inflation peaked at 9%. It's just been a long slog since inflation peaked. And so getting back to the 2% inflation target is the more difficult thing right now. But of course, policymakers are more focused on the labor market. So as much as getting back to the target is the more difficult thing right now, all eyes are on the labor market.
What about the Treasury market and Treasury traders? I feel like the bigger thing, even though we talk so much about the equity market here, I mean, watching what has happened in yields, right? We're above 4%. For a while, I felt like we were talking that 4% was the high, and nope, we're going up there.
What the bond market is telling you is a couple of interesting things. If you look at what's happened this year, yields are actually lower across all maturities for this year. And if you dig into the entrails of the bond market and you look at what are real yields, the yields, adjusted for inflation, they're actually lower too. And that's a proxy for growth expectations. So the bond market is kind of leaning in the direction that labor is weakening. We're in a slow hire, slow fire mode. But bond traders in the back of their minds know that in the past cycles, that's usually tips over into a rapider pace or faster pace of job losses. So the other interesting thing here is that for all the angst about inflation and when is it going to arrive from tariffs or from some other source, inflation expectations, which the Fed used to really lean upon, have remained remarkably stable, and they're steady, and they're actually signaling that over time, the Fed will get back towards 2%. So I think what you've got then in turn is you've got some people in the bond market who are listening to some of the more hawkish members in the Fed Reserve, such as Beth Hammack, and saying, wow, they're really worried about inflation. And then they're listening to Christopher Waller, who comes from the sort of point of view that says the Fed should be more preemptive and get ahead of any risk to the economy and cut rates towards what is called neutral, which of course is a theoretical level that neither stimulates or slows the economy. And of course, the bond market thinks neutral's around 3.25. The Fed at the last summary of economic projections put the longer term dot in the dot plot at 3. So that'll be something that people will be watching tomorrow, whether there's any shift in that longer term dot. Because that's the debate. Is the Fed going to get to neutral? Is the Fed actually going to have to go beyond neutral, or can the Fed stop before it gets to neutral? And that's what's going to really determine how we open up the beginning of 2026 and proceed. And then you throw into the mix the potential for a new Fed chair who comes in, and who knows?